The number that ruins most people is not 50%, it is 5%, a market that falls 50%. Gets your attention, a system that slips 5%, then 7%, then 9%. While television tells you to stay calm, keep buying, keep averaging, keep trusting, that is the system that really empties lives. That is the polished floor that feels solid right before the trapdoor gives way. When I look at what is happening in credit today, I do not see one dramatic explosion yet. I see a trapdoor, I see a floor that still looks expensive, respectable, institutional, diversified, professionally managed, and perfectly normal. I see people standing on it with their retirement, their salary, their mortgage, their children's future, and their idea of safety. And I see almost nobody asking the only question that matters. What is actually holding the floor up? That is how a serious financial break starts. It does not start with panic, it starts with confidence. It starts with people repeating the same sentence so often that they stop hearing how foolish it sounds. Buy the dip, stay diversified, do not try to time anything, just keep walking, just keep spending. Just keep assuming that because the floor held yesterday it will hold tomorrow. That is not wisdom. That is social hypnosis. I have spent my life allocating capital, and I will tell you something plainly. The crowd never notices the trapdoor while asset prices are still reflecting the old story. The crowd notices it after the hinge snaps. By then, the people who depended on salary instead of strength call it bad luck. The people who confuse paper gains with liquidity call it unfair. The people who outsource judgment to slogans call it a black swan. Most of the time, it is none of those things. Most of the time, the trapdoor was built in public. It was visible in the incentives. It was visible in the lending. It was visible in the way risk was renamed yield. It was visible in the way opacity was marketed as sophistication. It was visible in the way weak borrowers were repackaged as premium opportunity. I do not think you should live in fear. Fear is expensive, panic is stupid, but I do think you should learn to recognize rotten flooring before your full weight is on it. That is where we are now. The modern financial system has created a very elegant way to hide weakness from ordinary people. It takes bad lending, weak covenants, borrowed money, smooth valuations, slow disclosures, and optimistic language. And it turns all of that into something that looks respectable. That machine has a name today: private credit. Now, let me say this carefully. Private credit by itself is not evil. Lending outside public markets is not automatically reckless. In the hands of disciplined people, almost any tool can be used intelligently. But a tool becomes a trapdoor when the system around it rewards volume over judgment, appearance over liquidity, and yield over truth. That is when a useful market becomes a silent hazard. People think every new crisis has to wear the old costume. That is why they miss it. They look for subprime mortgages, because that was the costume in 2008. They look for the same bank names, the same acronyms, the same television graphics, the same official statements, the same villains. They waste time looking for a rerun while the new trapdoor is being installed under a different room. The pattern is what matters. The costume does not matter. In the last great financial panic, the floorboard that cracked was mortgage credit this time. The floorboard may be private credit, different room. Similar mechanics in both cases. The story begins the same way. Easy money produces easy confidence. Easy confidence produces weak discipline. Weak discipline produces bad lending. Bad lending produces the need for narrative. Narrative produces inflows. Inflows produce even worse lending. Then one day reality asks for cash instead of adjectives. That is when the floor starts to open. You should understand the psychology because the psychology is what traps you first. When prices rise for years, the human mind stops calculating and starts imitating. You tell yourself that every decline is an opportunity because that has been rewarded recently. You tell yourself that your retirement account always recovers because it usually has. You tell yourself that large institutions would never allow dangerous things to accumulate in plain sight because you still believe size is the same thing as prudence. It is not. A giant institution can be just as foolish as a small one. Sometimes more foolish, because a giant institution can hide its stupidity behind better branding. That is why late cycle losses feel so personal. They do not just hit your brokerage account, they humiliate your worldview. You realize too late that what felt safe was simply familiar. The reason I want you to think in terms of a trapdoor is simple. A trapdoor is not obvious from the top. From the top, it looks like floor. It is flat, it is polished, it matches the room. People walk on it, clean it, decorate around it, and build plans on it. But underneath, the structure is different. That is private credit in a late cycle. From the top, it looks like stable income. It looks like yield without volatility. It looks like institutional quality. It looks like a nice alternative to public markets. It looks like a smoother ride than stocks. It looks like a better answer than cash underneath. In too many cases, it is leverage, weak borrowers, circular marks, delayed price discovery, and the constant need to keep confidence alive. Confidence is the whole game. Once confidence has to be replaced by cash, the trapdoor stops pretending to be floor. I want you to connect this to the real economy because people make a huge mistake here. They think financial plumbing is some abstract topic for traders, analysts, and rich men in New York. That is nonsense. Financial plumbing decides who gets hired, who gets fired, who gets refinanced, who gets rescued, and who gets sold. It decides whether weak companies can keep rolling over debt. It decides whether payroll survives one more quarter. It decides whether banks pull back from lending. It decides whether your portfolio gets a normal correction or a forced liquidation. If the floor under credit weakens, the ceiling over your life comes down with it. And the timing matters. What makes this period dangerous is not only the credit issue. It is the combination of credit fragility with macro pressure. When oil moves sharply higher, you are not looking at a line on a commodity chart. You are looking at a tax on the real economy. Every truck feels it, every commuter feels it, every manufacturer feels it. Every family already stretched by housing, insurance, food, and debt feels it. At the same time, when labor data weakens, when hiring softens, when payrolls wobble, that means the economy is losing its cushion. Now put those together: higher energy pressure, weaker labor momentum, and beneath both of them, a large pool of private lending that has been priced as though stress never really arrives. That is not a stable combination. That is weight gathering on the trapdoor. One of the great mistakes ordinary investors make is assuming that central banks can always rescue any situation cleanly. That is fantasy. If inflation pressure rises because energy surges, central banks have less room to cushion growth. If growth weakens while prices stay sticky, policymakers are caught between two bad choices. That is where accidents happen. That is where people discover that the rescue they had mentally prepaid for is smaller, slower, and more politically difficult than they imagined. The market spends years training you to believe the floor is reinforced. Then macro conditions change, and you find out the reinforcement was mostly language. Now let us walk through the mechanism, because you should never fear what you can diagram. Here is how the trapdoor gets built. A normal bank looks at a borrower and says no, that no matters, that no is civilization. A serious financial system needs people whose job is to deny capital to weak ideas, weak borrowers, and weak structures. The refusal is not cruelty. The refusal is how the floor remains load-bearing. But then another player arrives. This player says yes, not because the borrower has become stronger, not because the business has become safer, not because the cash flow has become more reliable. The yes comes because there is money that must be placed, yield that must be manufactured, and a story that must be sold. That is the moment a market shifts from financing enterprise to financing appetite. Private lenders can borrow, syndicate, slice, warehouse, refinance, and relabel. They can lend where banks pull back. They can offer speed, discretion, custom structures, and flexibility. Again, none of that is automatically wrong. The problem begins when too much money chases the same spread. The problem begins when lenders run out of high-quality borrowers, but do not run out of fundraising ambition. The problem begins when standards quietly soften because the machine needs more paper to feed on. Then you get the late cycle disease. You start by lending to decent borrowers at a good rate. Then you lend to weaker borrowers at a higher rate and tell yourself the extra yield compensates for the extra risk. Then you lend to businesses that are not really investable in a hard environment. But the coupon looks beautiful and the valuation is an internal conversation instead of a public verdict. Then you create side pockets, feeder vehicles, continuation structures, layered funds, and related exposures. So the weakest assets do not immediately reveal themselves. That is when the trapdoor becomes dangerous. Because now the floor does not merely depend on borrowers paying. It depends on the narrative holding. It depends on marks staying smooth. It depends on redemptions staying limited. It depends on lenders being able to refinance themselves. It depends on nobody demanding honest, immediate, arm's-length price discovery. It depends on people continuing to accept the difference between an unrealized gain and actual cash as though they were close cousins. They are not close cousins. In a panic, they are strangers. I have always preferred businesses I can understand, not because complexity is immoral, but because complexity is where accountability goes to die. If I cannot tell where the cash comes from, who owes what to whom, what happens under stress, and how quickly truth arrives when conditions worsen, I do not call that sophistication. I call that exposure. A lot of modern finance is built on your willingness to confuse smooth numbers with safe numbers. They are not the same thing. Public markets can be brutal because they tell the truth quickly. Private structures can feel comforting because they delay the truth. But delayed truth does not become smaller truth. It usually becomes larger truth. That is why I would rather take the pain of visible pricing than the false piece of hidden pricing. A quoted market embarrasses you early. An opaque market can bankrupt you politely. You should also understand the circularity that creeps in during a credit boom. When money pours into a strategy, managers feel pressure to deploy it. When they cannot find enough strong opportunities, they start financing weaker ones. When even that becomes difficult, the system begins financing itself. One vehicle owns a stake in another vehicle. That vehicle lends to a third structure. The third structure holds claims linked to the first or second. Everyone reports values based on models, manager marks, comparable assumptions, financing terms, and confidence. Very little is tested by urgent selling. Very little is challenged by open bids. Very little is forced into daylight. So the floor continues to look smooth. But the smoothness is not strength. The smoothness is concealment. If new money is needed to satisfy old promises, stabilize old marks, maintain old distributions, or roll old exposures, then you are no longer dealing with robust compounding. You are dealing with dependency. And dependency is what makes a trapdoor swing. I have seen enough cycles to know that investors love words that hide mechanics: alternative, private, enhanced, opportunistic, institutional, defensive income. These labels are often less important than one ugly question. If confidence disappears, where does the cash come from? If you cannot answer that, the floor is already creaking. Now let us bring this back to you, because this is the part people avoid. They enjoy macro theater, they enjoy scandal, they enjoy villain stories, they enjoy feeling informed, they do not enjoy inventorying their own fragility. So I will do it for you. Your job is not safe because your employer has a good brand. Your job is safe only if your employer can survive tighter financing, slower demand, higher input costs, and a more selective credit market. If your company lives on refinancing, promotional growth, optimistic projections, or permanently cheap capital, then your salary is standing on the trapdoor whether you know it or not. Your portfolio is not safe because it is diversified across tickers. Your portfolio is safe only if you understand how many of those tickers depend on the same credit conditions, the same consumer strength, the same liquidity assumptions, and the same belief that lower rates will always arrive in time. Most diversification is cosmetic. 10 positions can still sit on one trapdoor. Your bank is not safe because the building is large and the logo is old. Your bank is safe only if its exposures are understandable, its counterparties are credible, its funding is durable, and its management is disciplined enough to respect what it cannot see. Size can absorb a shock. Size can also hide one. And that is before we discuss pensions, insurance companies, endowments, wealth products, private funds, listed equities with shadow credit exposure, and all the other channels through which one weak floorboard can transmit pressure into places the public thought were separate rooms. They are not separate rooms. They are the same house. That is the lesson people miss every cycle. They think the trapdoor belongs to somebody richer, somewhere farther away, inside a fancier room. Then the hinge breaks and they realize the entire house shares one frame. You must also resist the moral laziness of assuming that regulation alone protects you. Regulation matters. Honest oversight matters. Transparent accounting matters. But incentives matter more than speeches. If a system rewards asset gathering, smooth reported returns, delayed recognition, and institutional storytelling, then weakness will travel toward the places where pricing is most flexible and accountability is most negotiable. That is just human nature wearing a suit. So when I see a market filled with opaque loans, internal marks, redemption friction, rising macro pressure, and the return of the old belief that trained professionals can transmute weak credit into safe yield by arranging the paperwork more elegantly, I do not call that innovation. I call that the late phase of forgetting. Every bubble is ultimately a memory problem. People remember the upside. They forget the mechanics. They remember that buying previous dips worked. They forget the specific conditions that allowed those recoveries. They remember that policymakers stepped in. They forget that policymakers do not repeal losses. They decide who recognizes them first. They remember the headlines after a crash. They forget the soft language before it. That is why I am less interested in whether the next break perfectly resembles the last one, and more interested in whether the same blindness is back. And yes, the blindness is back. You can hear it in the language. People say the system is more sophisticated. Now people say risk is distributed better. Now people say private markets are less volatile. People say these managers have experience. People say there is a lot of dry powder. People say banks are better capitalized. People say the economy is resilient. Fine. A floor can be well decorated and still not be load. Bearing what matters is not whether the room sounds confident. What matters is whether the trap door can stay shut when weight is added. This is where I want to speak to you, not as a commentator, but as a capital allocator. Your first duty is not to maximize returns. Your first duty is to avoid irreversible stupidity. There is a tremendous difference between temporary embarrassment and permanent impairment. A stock that falls and later recovers can embarrass you. A structure that denies you liquidity, forces sales, or destroys earning power can impair you. Most people build their financial lives backward. They optimize for visible lifestyle first and structural resilience second. That is insane. They buy the car payment, the big mortgage, the status consumption, the private school stretch, the recurring subscriptions, the expensive neighborhood, the fragile career identity, and only after that do they ask whether they have enough cash, enough optionality, enough margin of safety, enough refusal power, That is how ordinary income becomes elite insecurity. Your salary is not freedom if it disappears the moment credit tightens. Your house is not safety if you cannot comfortably carry it through a contraction. Your portfolio is not wealth if it requires benign liquidity to remain intact. Your reputation is not strength if it is built on spending money you have not truly earned through durable ownership. This is why I care so much about what I call refusal power. Refusal power is your ability to say no without your life collapsing. No to bad financing, no to desperate selling, no to stupid partnerships, no to employers who own your nervous system, no to the social pressure to look richer than you are, no to yield you do not understand, no to products that promise calm while hiding terms, no to the trapdoor. Most people have no refusal power because they have optimized for appearance. Appearance is expensive, independence is quiet. You cannot have both at full volume. When a credit break comes, the person with no refusal power becomes obedient overnight. He sells what he should keep. He keeps what he should sell. He takes the job he hates. He accepts the terms he should reject. He borrows at the worst moment. He becomes financially available to everyone except himself. That is not merely a money problem. That is a dignity problem. And dignity is one of the few assets worth defending before a crisis, not after it. So what do I do when I see a trapdoor under the floor? I do not perform for the room. I step back from the hinge. I lower fixed obligations. I increase liquidity. I become more selective about what I own. I look for businesses with strong balance sheets, real cash generation, pricing power, and less dependence on rolling debt. I pay close attention to incentives. I ask where the real buyer would be if conditions turned. I prefer clarity to excitement. I prefer cash flow to narrative. I prefer boring strength to fashionable opacity. I do not need to predict the exact day the floor opens. I only need to know whether I am standing in the wrong place. That is the discipline most people refuse to learn because it feels less thrilling than forecasting. Forecasting is vanity, positioning is survival. You do not need a television, ready opinion about every chart, every bank, every rumor, or every macro headline. You need a structure that does not require perfect timing. That means you should look hard at your personal floor. How many months could you live without income? How much of your lifestyle is fixed rather than flexible? How much debt in your life floats with rates, sentiment, or refinancing conditions? How much of your portfolio do you actually understand? How much of it depends on somebody else marking an illiquid asset kindly? How much of your confidence is based on the last 10 years instead of the next 3? Those are ugly questions. Good. Ugly questions build strong floors. Pretty answers build trapdoors. You should also separate ownership from illusion. Ownership is a claim on productive assets that can survive stress and continue compounding over time. Illusion is a statement showing smooth returns in structures you do not understand. Funded by borrowers you cannot evaluate. Supported by liquidity you cannot test. And blessed by institutions you assume are smarter than you. That is not ownership. That is rented confidence. And rented confidence gets evicted fast. There is another lesson here that matters more than any single market call. The real danger in a credit boom is not only financial loss, it is moral passivity. People stop thinking, they outsource judgment to labels. They assume that because something is legal, marketed, and widely distributed, it has passed some deep test of soundness. It has not. Many things are sold because they are profitable to sell, not because they are wise to own. Once you understand that, you stop asking whether the crowd approves. You start asking whether the structure survives. That shift alone can save you years of pain. I have no interest in teaching you to become a pessimist. Pessimists often miss compounding because they enjoy being right more than they enjoy being rich. But I am absolutely interested in teaching you to stop being a volunteer victim. There is a difference between courage and compliance. Buying strong assets at sensible prices and holding them through noise takes courage. Blindly repeating slogans from a bull market while leverage opacity and macro stress gather beneath you is not courage. It is compliance. And compliance is how the middle class walks onto trapdoors built by people who will never attend the funeral. If this period passes without a major break, wonderful. You still lose nothing by becoming harder to kill. You still lose nothing by understanding your exposures. You still lose nothing by building liquidity, reducing fragility, and demanding simplicity from your investments. You still lose nothing by separating real ownership from engineered yield. You still lose nothing by refusing to confuse a smooth return path with a safe one. That is the beauty of sound preparation. It pays you even when the storm weakens. But if the pressure intensifies, if refinancing dries up, if losses emerge in ugly places, if lenders pull back, if employers cut deeper than expected, if markets discover that a large share of reported stability was simply delayed price discovery, then the people who prepared will not look brilliant. They will look boring. That is enough. Boring survives. Showmanship gets margin called. So let me leave you with the truth most people avoid because it is too personal. The trapdoor in your life is rarely only in the market. It is in your habits. It is in your need to appear successful. It is in your dependence on a paycheck that can be interrupted. It is in your willingness to own things you cannot explain. It is in your habit of borrowing against tomorrow to feel larger today. It is in the gap between your public life and your private resilience. That is where the hinge really sits. A financial crisis does not create fragility. It reveals it. The market does not decide whether you are trapped. It exposes whether you built a life with a floor or a trapdoor. So here is the test. If credit tightened hard tomorrow, if your industry cut fast, if your portfolio dropped sharply, if refinancing became selective, if polite words could no longer postpone honest prices, would you still control your decisions? Would you still have time? Would you still have cash? Would you still have dignity? Would you still have the power to say no? If the answer is yes, keep strengthening it. If the answer is no, stop decorating the room and fix the floor, because the people who make it through the next serious break will not be the people with the loudest opinions. They will be the people who recognize the trapdoor before the room started screaming. And once the room starts screaming, the choice is mostly over. The real choice is made earlier, in silence, while the floor still looks perfectly safe. That is where you are standing now. Choose carefully.